Welcome back to another video. In this video we're going to be focusing on TGIF. This is a popular slogan, TGIF. It stands for Thank God It's Friday. And this is a model that's taught by ICT. And specifically breaking it down, you know that we have Friday, right? And just looking at the weekly range, we're focusing on a specific day. And that specific day happens after 4 previous trading days: Monday, Tuesday, Wednesday, and Thursday. So this means that in order for you to have this model on Friday, the previous 4 days have to align with the weekly profile, right? It has to be an optimal situation for you to actually trade this day with your model with a bias. Like, you come in already knowing that it's likely to create this pullback of the weekly range. So this model revolves around these 4 things on the top of the chart right here, which you may not know what they are. Notice how they change every time I move my crosshair? This is open, high, low, close. And the reason why they change is because this is the open, high, low, close of the candle that you're hovering over. So I turned on my crosshair right here. You can see that if I take this candle, put it up close right here to the right side, the open of a bullish candle is this right here. Let me hop into full screen. The open right here, and you can see on the top left of my screen it says 19,496. That is the open, right? Look to the right now, 19,496. The high of the candle right here, 19,615. That's what it says right there on the top. Open, high, low, close. And I'm on the 1 hour time frame. The idea of TGIF is that there is this open, high, low, close of every weekly candle. Every weekly candle, right? We have the open, the high, the low, and the close, making it bullish or bearish depending on where it closed. So the idea is that you take your range starting from Monday to Friday, creating a high, and from that high on Friday, the last day of the week before the weekly candle closes, you look for a pullback to create the wick on the weekly candle. Right, so the understanding is kind of like this. And ICT teaches that it pulls back to at least the 0.2 or 0.3 zone. And while this is a specific number that you can use to kind of nail it down, I'd recommend that you don't specifically focus on 0.2 or 0.3, but rather you focus on the confluences within the week that it's likely to pull back to. So let's hop into that specific week I just outlined, and let's see what happened. I have to print one more weekly candle. There you go. So hopping on the 1 hour time frame, starting from Monday's range, which would be down here, to Friday's range up here, Wednesday, Thursday, and Friday from midnight right there. Okay, so the idea is that you take the Fibonacci from the bottom to the top of the weekly range, and you're basically looking for Friday during the news event. Let's see, Friday, 8 a.m. So somewhere around here, 8 a.m. You're looking for Friday's news event. 8:30 is typically when news events happen. You're looking for Friday to create a high of the week. Of the week. Basically, it running above previous day high and creating the high of the week so that you can anticipate another pullback of the weekly range. So in this case, it happened later in the afternoon, actually on Sunday in the following week, where we swept the previous Friday's high. This is what I would have optimally liked to see on Friday before the weekly range closed, because in this case, it's already a new week. It's not a significant or high probability model. I'm just using this weekly range to show you that instead of looking at the specific location 0.2 and 0.3, you would rather look for a confluence somewhere around that zone, which would be a fair value gap, right? So if you're looking for a pullback on Friday, then I'd rather look for the fair value gap than I would the 0.2 or 0.3 of the weekly range. But that's how the model goes. So basically you're looking for a sort of range in the week, starting from Monday to Friday. Accidentally deleted my Monday to Friday. There you go. So at the start of the week, this one is obviously a bearish week. So I would take the Fibonacci from the high to the low of somewhere around 10 a.m. 10 a.m. is my optimal trading time, right? It's when the silver bullet happens. And while this Friday was a little more bearish than I would have expected, 10 a.m. is typically when I would have been looking for my setup, right? So from the low of the week, once I got that first order block, and I would have started suspecting that the week is likely to be a TGIF model, just because of sweeping some sort of liquidity. Once I start seeing those confluences on the lower time frame start turning around, then you start looking for price to pull back and the weekly candle to close somewhere around the 0.2 or 0.3. Nasdaq doesn't seem to be like the best pair to show you TGIF on. I was going to show it on gold. However, gold has been ranging towards all-time highs. So it's also kind of hard to point out a TGIF model. Thursday, Friday, let's see a perfect TGIF that I can show you. Thursday, Friday. No. Monday, Tuesday, Wednesday. Okay, that's the same week. Friday, that was bullish Friday. Friday. Okay, a Friday that did exactly what we would imagine a TGIF model to do. So even though this was kind of pushing towards all-time highs and there's no previous confluence kind of supporting a pullback, instead of looking for a previous confluence to take a pullback, you're kind of looking for the 0.2 or 0.3 range that I was telling you about. So in this case, right, starting from Monday's low, this would be the lowest point created during Monday, right? Monday opens somewhere around here. We take the low to the high of Friday. So the reason why I say that this is an optimal like week is because Friday right here, this candle, 8 a.m. candle, is a candle that had a news event. And this news event ran up and swept the all-time highs, which were also the weekly highs, right? We had a weekly high right here. That weekly high was swept right here on Thursday. It was once again swept early London session on Friday and during New York news. So when this happens and it sweeps the high, I'm looking at 10 a.m. for the pullback because 10 a.m. is the silver bullet. That's when I like to trade. And you can see that diving into this specific candle will likely to give me a pretty solid setup on Friday because I'm looking for a pullback into this range right here. And instead of looking at the 0.2 to 0.3, I'd rather look for a fair value gap or confluence that supports that. And in this case, we have this 4-hour fair value gap, right? Obviously, this candle is already printed right here, but we're on the 4-hour time frame. So diving back in, we're just imagining that that candle didn't just print. And this is what we see right now on the 4-hour time frame. We have a 4-hour target, which is the 4-hour bullish fair value gap. Let me change that to green because it's bullish. And we're basically targeting that the pullback of the weekly range on Friday to pull back and close somewhere around this 4-hour fair value gap, right? So diving even lower, we're now inside of the 10 o'clock hour, and I'm looking for some sort of model to get me in an entry at 10 o'clock to run to this fair value gap. And I already see what is going on right here. We have a fair value gap, right? Kind of nailing down the obvious. What happened here is an order block formed, right? We had two bullish candles and the low of that bullish candle was ran right here. So pulling back, we already ran and tapped back into these order blocks and we have this bearish FVG. Right, so once that 10 o'clock hour starts, I would be looking for sells. I'd probably already be in sells right here. And if I was to get stopped out, I'd likely look for another trade because there's clear equal lows right here and there's this resting 4-hour fair value gap. So starting from 10 o'clock, we're trading the silver bullet and we're aiming for the lows. Let's look for more confirmation. Now that we just traded below this low, we also created another order block. We just closed below this IFVG right here. This bullish fair value gap also became a bearish fair value gap. Or actually it was already a bearish fair value gap. What am I talking about? This bullish fair value gap right here becomes an IFVG. Let's see if price uses that one at all. It doesn't. It seems like a lot of volatility just kicks in, and we run towards the sell stops instantly right here into the 4-hour fair value gap. But that's kind of the idea, that on Friday, if it's optimal and news at 8:30 a.m. like this runs up and creates the weekly high, then the weekly candle is likely to pull back on Friday and create the wick of the weekly range. So in this case, on the weekly time frame, you can see that from the high, let me get rid of all this. So this specific week that I just showed you, right, we got this huge wick. And that wick is the pullback that we just traded on Friday. The idea was that Friday just created a new high of the week, and we got an opportunity to get in at an optimal level, which would be the quote-unquote high of the week, to trade down to the 0.2 to 0.3. And that's exactly what it did, right? Friday's news ran up, created the high of the week, and after that news, we only ran down. And we would have gotten our take profit at the 0.2 to 0.3 range, which in this case was just that 4-hour fair value gap right there. I hope that this video helped you understand TGIF better. You have to do a lot of experimenting, and obviously the circumstances of that week have to align properly for you to actually trade it. So for this model, let me give you a short little review. TGIF, you look for Monday's low to Friday's high. 0.2 to 0.3 pullback of weekly range. Optimally, you want Friday's 8:30 news to sweep and create all-time highs. And then you want to trade 10 a.m. silver bullet to the nearest confluence /FVG that aligns with the 0.2 to 0.3 range. So these are kind of the rule sets that I'd have for myself trading the TGIF, right? Just from my understanding of price action, I always want Friday to create that high of the week. That gives me an opportunity to get a high probability trade from the very high of Friday's daily range. And we're obviously targeting the nearest confluence. If price action's choppy on an NFP week, then you're likely not going to get the most perfect target on Friday, and it might be better either risking very little, being conservative, or not trading at all. Start practicing this model, start seeing it on your Fridays, and let me know what you find. If this video helped you, drop a like, give me a subscribe, and I'll see you next time.